Welcome to the Treasury Whisperers Talkcast podcast, your go-to source for insightful interviews and dynamic panel discussions in the worlds of treasury, banking, payments, fintech, and much more. Here now is your host, the Treasury Whisperer, Seth Marlowe.
Hello, Whisperees. Joining me today in the Whisperer studio is Eric Schwartz. Eric is an operating partner at Canapi Ventures, where he's responsible for platform services and strategic investor relations. Eric has spent his career at the intersection of traditional financial services and fintech, serving as a successful operator, advisor, and investor. Eric joined Canapi after 13 years at Promontory Financial Group, where he was a managing director and head of the strategy and optimization practice. Prior to Promontory, Eric was part of the founding team at IntraFi, a fintech that offers funding products, investment solutions, and liquidity management tools to the banking and brokerage industry. Eric, welcome to the Treasury Whisperers Talkcast podcast.
Thanks, Seth. Great to be here and honored for the invite.
Absolutely. A pleasure to have you, Eric. So as I start most of these shows, usually want to know how people got into doing what they're doing. You've had I'd say a fascinating career across financial services in the investing space. How did you ultimately find your way, I guess, into venture capital?
Somewhat by accident. I think my whole career has been a happy accident. And I think most people might have that response. At the risk of going in too far into the Wayback Machine, I graduated college just in time for the internet bubble to burst and was supposed to go be a baby investment banker on Wall Street at Credit Suisse First Boston. Got a call about 2 or 3 months before graduation saying, hey, we overhired for your analyst class. You can come work for us, see what happens, or we'll pay you half your salary and take the year off and come join us in the 2002 analyst class. And like any good graduating senior, I was like, great, I'll take the money. I grew up on the Jersey Shore.
Good choice.
Yeah, exactly. So I'm like, oh, I'll hang out at home on the Jersey Shore for a year or figure out something to do. And it just so happened that around the same time, Gene Ludwig had just left Deutsche Bank as vice chairman. He was comptroller of the currency under President Clinton and was forming his own merchant bank advisory company here in Washington and was looking for an analyst intern for some period of time. One of my college professors grew up with Gene in York, Pennsylvania. And next thing I knew, I was starting an internship in July of 2001 with Gene. And it is almost July of 2026. So it's almost been 25 years where I've worked in and around Gene and his ecosystem through IntraFi, getting off the ground, Promontory, Financial Group, another Gene company, and then Canapi, which is kind of the product of a number of different partners coming together, Gene Ludwig and Walker Forehand, legacy Promontory folks, and then Chip Mahan and Neil Underwood from Live Oak Bank and Encino. So I've gotten to know those guys over the past 15 years and came to venture really because of the background I've had engaging with, selling to, advising banks for the past 20 some odd years. And they needed someone to run the bank network that we have here and help our portfolio companies continue to grow. And in so many ways, Seth, I really feel like this is like a capstone part of my career. It brings together so many of the different things that I've learned, dare I say, not yet mastered over the career, but certainly a lot of things that I get really excited about.
And presumably, as this first job brought you down to DC, it was down to DC to stay, I guess, right?
Yeah, actually, I moved here for college and never left. So, it's been a great place to raise a family and to, so to speak, grow up. And I'm pleased. I spent a tremendous amount of time in New York, but never lived in the city, and luckily never had to pay city tax because I was always up there for a day or two. At one point, I had an office in New York and Washington and would go back and forth every week. But I never quite had the New York experience, but I guess I had the New York experience on an expense account, which was the best way to do it.
Yeah, I would like to arrange that too. So tell us a little bit about Canapi, and you mentioned some of the partners that kind of came together to form Canapi. But I think it's an interesting story in the marketplace, especially when you look at, as I do, treasury and banking and payments and fintech. So go ahead.
Yeah, so Canapi, we launched our first fund in 2019, and really the genesis of the fund was, at one point, Gene and Walker, Neil and Chip were talking about the fact that they've collectively made individual investments in financial services technologies. But, oftentimes the banks that either Live Oak partners with or that we advised at Promontory, we're also looking for new technologies and or new investment opportunities for them to participate in as well. So that really became the genesis and the catalyst for the formation of Canapi, which at its core is a bank-backed fintech and enterprise software venture fund. So what does that mean? We invest in companies that promote and provide products and services for the banking system, and very, very broadly. So, traditional banks as well as asset managers, broker dealers, insurance companies, et cetera, but do not compete against them. So, for example, we don't invest in consumer fintech. So we're not investing in the Chimes of the world and the Daves. That would be competing against the banks that back us. And over the past 7 years, we now count 72 financial institutions as part of our limited partner base, ranging from the largest banks in the country down to, very small community banks, sub-billion-dollar banks that look to us for really two things. The first is, of course, as a venture fund, venture returns. So, hey, I'm going to invest in the company, I need to see a return from it. But just as important, and in some cases maybe even more important, they look to us for strategic insights as to what's going on in the market. So help us understand the lay of the land when it comes to the future of wealth management, the future of treasury services. What's this whole stablecoin thing, and what should our strategy be? And that's really a lot of what my team is responsible for. We spend a lot of time either face-to-face or on Zoom with our banks, understanding their pain points, understanding their strategic priorities, and then helping them to evolve their strategies, introducing them to companies we're meeting through the investment process or companies that we've invested in directly, so they can take advantage of a lot of these new capabilities.
So I imagine as part of this, there's a great opportunity to get the banks who have invested in the fund to mix and mingle with the fintechs that you've invested in and that they have indirectly invested in as well.
Exactly. And there are a couple of key metrics that we track to kind of evaluate how we're doing. And that's one of the most important ones for us, Seth. It's I would argue, our most important KPI. And thus far, we've helped to facilitate 250 commercial agreements between the banks that we invest on behalf of and the companies that we actually invest in. So if you think about what that means, we've created within the Canapi ecosystem this kind of virtuous flywheel where we're developing and driving enterprise value internal to both sides of the trade, so to speak. So the buyers of software, the providers of software. And last year, we estimated that we helped just within our ecosystem drive about $100 million worth of annual recurring revenue across the portfolio, which makes such a huge difference for the fintechs that we invest in and also the banks, making sure that they're getting real value out of their IT partners.
Right. I mean, to me, I think one of the great things as one of the banks that's investing is that not only are they looking for the returns from the fund, but to the extent that they're actually partnering with the companies in the portfolio, that's helping the bank to drive revenue as well. So I don't know if calling it a double dip is really right, but in essence, it's a dual source of revenue for the banks that are going down that path.
Yeah, absolutely. And another way I kind of look at it, it's a strategic differentiator for a lot of the banks where, unfortunately, so much of our industry has become commoditized. So how do you better serve your customers, either from a relationship management perspective, product and service perspective, that make you stand out against every other bank on the street? And importantly, for smaller banks, how do you compete with the largest banks in the country from a product set perspective, so you can go after the mid-size commercial customers that may not have even been within reach because your product set was much more limited because of legacy tech or just the ways that you've been managing those products in the past.
So I imagine there are any number of competing firms that are doing similar things. Are there situations where you and one or more other firms are investing in the same fintech, bank tech partners?
Sure. I mean, Ed, we co-invest with some of the big names out there like Andreessen and Sequoia and Insight. But we also co-invest with other funds that have a similar model to Canapi. So there are plenty of situations where we're both on the cap table. Canapi, just given our size, we typically will have a board seat and play a much more active role in the governance and providing advice to the company. I should say advice and support. So we have a whole platform team that is really focused on helping our fintechs improve their sales motion, improve their people strategy, people operations, and obviously the regulatory strategy as well, given they're selling into a regulated base. So we luckily have resources available to us to add a tremendous amount of value to our portfolio in conjunction with other investors that are on the cap table.
So how early is appropriate to get started with a company? I mean, are you doing seed funding, or are you waiting for Series A, B? Where in the spectrum does Canapi fit?
We consider ourselves stage agnostic. So we have a number of seed stage companies that we've invested in over the years. I would say, though, that our sweet spot is probably Series A, Series B. And over the past couple of years, with us building out a team in San Francisco and Tom Davis, who runs that office, we have an even greater focus on growth stage opportunities. So an example that I mentioned before we started recording is we were part of the spin-out of Candescent from NCR about a year and a half ago, actually almost 2 years ago, that Veritas ran, and that we were the only outside capital that they invited into the deal because of our familiarity with the industry, the landscape. And I think about 20 of our LPs were actually Candescent customers. So they saw a lot of value in us being able to help facilitate that spin out, and also, helping to drive product roadmap and making sure that they're helping to evolve the company to meet the customer need.
Interesting. Now you mentioned there, some 20 LPs that were involved there. Out of what's the population? I don't know if you can even share that, but I'll ask anyway. What's the population of LPs in total that are invested?
Yeah, we've got 72 financial institutions ranging from, it's mostly banks. We have a couple insurance companies, a couple of asset managers in play as well. So, and all of the investments that we're making, and I'm hearing Chip Mahan's voice in my head when I say this, is how does this company help our investors? How does this investment in said fintech or enterprise software company help the banks and financial institutions that entrust us with their capital to deploy? So, day in and day out, we're looking at companies that are solving the problems of our investors and making sure that they're relevant. And as we raised Fund 1 in 2019, Fund 2 in 2022, 2023, as we evolved our investment strategy, we started spending more time in enterprise software in addition to, traditional fintech, bank tech. And the reason being that we recognize that financial institutions are enterprises too. So they need things like legal tech. They need things like marketing tech, DevOps, cybersecurity. So while, some of the newer companies that we've invested in, Island comes to mind, which is an enterprise browser solution, they have the Marriotts of the world and massive companies in addition to financial services. So financial services is a important vertical for these enterprise software companies, but not the only vertical.
Okay. So what makes a great fintech that you want to invest in them?
I think so much of it comes down, particularly early stage, to the founder and his or her perspective on understanding the problem. There's lots of incredibly bright Stanford dropouts who, it's that old adage of, what, and I'm going to ruin this one, but why do you rob a bank? Because that's where the money is. Why do you build fintech? Because that's where because the banks buy it and that's where the money is. And I think so many of our founders know the problem and understand the problem that they're building and solving so deeply because they lived it for some period of their careers. So I continuously believe in the founders that we back, the fact that they in many ways are dedicating their life's work or throwing everything, financially, emotionally, otherwise into building their company. That those that have operated in the industry for an extended period of time who deeply understand the problems are going to be the ones that are successful. Why? Because they've almost solved for that product market fit component that is oftentimes the killer for so many early stage companies where, hey, you're sitting around, you have this great idea, well, but no one else wants to buy it. But you don't understand that until you've actually started building it. Or in our case, you've operated in the industry for so long, you
Mhm.
deeply understand, like, why is this a problem? This is a problem I need to solve, and it's worth spending my time and money to actually do it.
Wow. It's interesting. In the past year and a half, I've spoken to a lot of founders. Some of that's been part of the show, but some of that has also been people reaching out to me in the industry as kind of a voice and a thought leader. And it surprised me where I've heard folks who have ventured into some of these spaces and they haven't really had an experience of their own where they understood the problem and they're still trying to figure out what really is the problem and who really is the target market. And is this really a problem that needs to be solved? And it sounds like the companies you're investing in don't have those kinds of founders.
I agree. And importantly, I think, especially when you think about an early stage company, that seed stage or series A, sometimes, dare I say, oftentimes there's some type of pivot, and knowing when you need to pivot versus continuing to like push on that closed door
Mm,
is like such an important distinction. So, maybe the problem that a founder started off solving made sense at the time, but she realizes at some point, like, actually, I need to move in this direction instead. That kind of self awareness and industry familiarity and context is so important to making sure a company's successful long term.
sure. So what would you describe as the innovation hotspots these days that bring excitement to the firm and to the founders that you're investing in?
Well, I mean, it's hard. We do a lot of survey work with our LP base.
Mm,
So, our most recent one, we were asking them to rank their strategic priorities for the next half year, give or take.
mm.
The two top ones, no surprise, were AI and digital assets. I don't think any of us have been to a conference over the past year where one of those words, and by the way, we're, I don't know, 17 minutes in at this point. We didn't mention either of those yet. So perhaps that's a win. There's obviously a lot from an investment perspective, a lot of, excitement, maybe bubble type behavior around AI.
Mm-hmm.
I think, in the digital asset space, I think there's a huge opportunity for our industry to really modernize our tech stack and the way we do business, whether it be payments use cases or just all the opportunity of tokenized assets and tokenized deposits that in many ways it's just a new way of doing things from a recordation perspective.
Mm-hmm.
So like that, we are like, from an investment perspective, we're always excited about, picks and shovels and like the infrastructure components of some of these opportunities, which is why we invested in Fireblocks many years ago, thinking that would be an important part of the infrastructure as financial services in general, and we're specifically, and then kind of the world in general started to engage more with digital assets and all the opportunities attendant to those.
Sure. So I'm curious, and this is on having recently published an episode with Scott Shea, the founder of Next, which has got all of this homegrown blockchain technology that's being used as the core banking platform for that bank. What are you seeing in terms of blockchain as an infrastructure to underlie all of this fintech capability that's out there?
Well, I mean, I think that's the hope and the dream specific to the banks that we work with. There's a broad range of familiarity and level of comfort in engaging with the technology. You look at the likes of the JP Morgans and US banks that have major areas of focus. Smaller banks like South State that with Chris and what he's been building down there is incredibly impressive. But those to me are the outliers. I was at a bank a couple of months ago. We were doing an executive briefing from Canapi and just talking about the market. And the head of commercial raised his hand and said, what should our stablecoin strategy be? Is that a 2026 or 2027 problem? And my response usually, and honestly, you can say like, what should my AI strategy be? It's one of those like, well, what type of customer demand are you getting for this? We oftentimes need to think more about like, well, what type of infrastructure have you already thought through and built at the bank in terms of capability before you start worrying about the specific strategy. So for example, I think in the blockchain context, regardless of where you go from a product perspective, there are certain things you need to have in place. You need custody, you need settlement, like all those types of building blocks that you need to understand very deeply. You need to get your regulators very comfortable with. And then you can start to figure out, okay, well, we don't have a cross-border payment business. Do you want to get into it? Probably not. or do we need to have a real-time commercial payments business on stablecoin or tokenized deposit rails, or can we just focus on continuing with our RTP or FedNow journey? And I keep coming back to, so it feels for many banks out there that stablecoin people get questions at the board level because their directors are hearing about this stuff.
Sure.
But the banks themselves are still trying to catch up along with all the other things they need to be doing to run the business day to day. And while I think down in the future, there's tremendous opportunity for us to use blockchain technology for not just payments, but I'm actually really excited about tokenized assets and what that means in securities markets and other types of real world securities or real world assets. But that's probably a 5 or 10 year type of journey versus something we need to be worried about today or tomorrow.
Right. Is there a concern that a lot of the banks, particularly in the regional bank environment, and maybe even down into the community bank side, that there's been such an acceleration of things to do that what was already a very delayed roadmap, I'll say, has gotten to be an even longer and harder to navigate roadmap? And I know there's some folks who are just, their heads are spinning. I haven't gotten instant payments up and running, and yet I'm getting pressure to do stable coins and all of this. Is there a right order to do all of these things? How do we help those banks to navigate all of this?
Yeah, well, when we figure that out, we can start a new consulting business, Seth, because I think
That's right.
this is one of the greatest challenges our industry is facing right now. And, it's the challenge of there are so many new shiny objects out there. It's hard to not chase them. AI certainly falls in this category as well, where, you think about all the different AI projects that so many banks are pursuing right now that either stall or fail because for any number of reasons. I think from a prioritization perspective, so much of it comes down to how can you better serve your customers and how can you better compete, particularly for the regional banks, where being laser focused on developing capabilities that will help you continue to deepen relationships with your existing customers, in my opinion, should be first and foremost when making that prioritization decision. It's really hard to win new customers. It's a lot easier to go to your existing customers and say, hey, Mr. Small Business, I know that we're currently providing you with these services. Now, because of this new partnership, I can do that much more. And I think that so much of, and that's from a treasury perspective, but I also think from an advisory perspective, the promise of AI and helping banks become more consultative with their customers is going to be a critical way of how they differentiate themselves moving forward.
So interesting you say that. I know of a number of companies, and I've had some of their key people on this podcast are coming at those customer insights from very, very different angles to be able to really equip bankers with having the right conversations with their customers that so often don't get deep enough, fast enough. And it just seems that there are a lot of ways to skin that cat, and there are a lot of folks that are trying to go down that path right now.
At the end of the day, this is a relationship business, and the more we can do to, I keep coming down to let humans do things that humans are good at, and machines do things that machines are good at, and very clearly separate the two is the way that we're going to make this work.
So in treasury and payments, what are the hot spots that banks should be focused on, and I guess fintechs for that matter, to create kind of the biggest opportunities over the next couple of years?
I'm increasingly of the opinion that the battle for deposits has already started transitioning to the ERPs and not the bank branches. You think about verticalization of software. And the fact that CFOs of medium, small businesses, mid-sized businesses don't want to do their banking on one screen and their ERP on another screen and then reconcile between the two. The more there can be embedded experiences in commercial payments and in commercial banking services, the better. And I feel really strongly that the companies that help to power that type of experience and the banks that embrace and adopt that type of experience are going to be the ones that succeed down the road, because all of that winds up creating and helping us to realize the vision of that agentic future where, again, going back to that, let machines do what machines are good at. we don't need to have humans reconciling accounts. We can have agents do that, and they can do it really, really well. They don't get tired. They work 24/7, and they're pretty inexpensive. And in my opinion, the more we can focus on integrations between banking backends and ERP systems where companies are running their businesses, the more successful the companies are going to be long term, and the more value that banks are going to be able to drive in terms of deposit capture and, frankly, payments revenue.
So with all the AI that is coming fast and furious, I had this conversation this morning with some folks as I'm going to be moderating a panel that actually talks about the ERP integration, the AI integration. And one of the concerns I have is that as all these different platforms, bank platform, digital platforms that are supporting the banks, the TMS vendors, the ERP vendors, there's going to be this plethora of AI that sits on top of each of these, but doesn't necessarily sit on top of all of it. And is there going to be this, I'll almost call it AI fatigue from having to remember, okay, well, this platform does it this way and is limited to this information. And this platform over here has got a different viewpoint on it. And am I going to end up in this kind of reconciliation nightmare of, well, this platform's telling me this and that platform's telling me that, but it's not bringing it all together?
I hope not. I think it's a very real concern, Seth. And at the same time, I think about the promise of MCP servers and how we're able to, and I even think of like some tools we've built here at Canapi that rely on MCP servers for systems we've built ourselves, along with Salesforce and other tools. And like to the extent, like one of the great things about that architecture is you have your models that sit on top of all that. So to some extent, you very well may have the problem that you just articulated, but when you can have agents and your LLMs go across them and pick out what you need, when you need it, and how you need it, I think there's going to be a better outcome, in addition to the fact that they can help with some of that reconciliation where you say, okay, well, we have this financial information in this MCP server and this in our Snowflake database. Why don't they? And then you're kind of managing by exception, and you're highlighting the differences between the two that you can reconcile instead of just introducing bad data into your system.
Right. It's interesting. Historically, there's always been this buy versus build conversation. And I think that conversation gets another vertical, I'll call it, which is the buy and build. Because you're going to have to buy products that you can't build yourself, but you're going to need to do some building to kind of do the overlays to get it all to fit together in your own ecosystem.
I totally agree. And actually that we've spent a lot of time here at Canapi talking about that in the context of companies that we would invest in. So like, where is there durability to avoid banks or, other industries building some of these tools themselves versus where they should absolutely buy them? And like so much of it comes down to the data that you have access to, the subject matter expertise that is critical in making sure that things work, the regulatory overlays that you have, particularly in financial services, healthcare, other regulated industries. So like from an investment perspective, we're really focused on companies that have that moat or those moats and that durability relative to ones where you could, vibe code on a weekend, a new CRM or what have you, or like the fact that is this software really enterprise grade software? In some cases, it's fine to do something in Lovable or Replit. But in many cases where you have PII or critical regulatory reports, you got to make sure that that's being done in your GRC tool or your ledger or what have you.
Right. So working with both the fintechs and the banks, what are the biggest things that you see that the banks still don't understand about the fintechs and that the fintechs still haven't figured out about the banks?
So much. And like one of the great things about where I sit is I get to play as this like translator or shuttle diplomacy between the two sides. I think, what banks don't understand about fintechs, so much of it really comes out during the vendor management and onboarding process. And I think about when the vendor management team at a financial institution asks early stage fintechs for things like unlimited liability, like that's like this is a company. It's just like a non-starter. But
Right.
it's like, well, but our vendor management policy says we need unlimited liability from our vendors. Okay, well, that's maybe fine for Microsoft or Salesforce, but you can't have that same type of posture for engaging with an earlier stage fintech. So I think so much of it is having some type of flexibility in your vendor onboarding process. So maybe it's one size fits most, but you need to be able to have some level of exception if you're going to be able to engage with and take advantage of some of these new technologies that are out there. I think from the fintech to the bank perspective, it's really easy to say, oh, banks are slow. Banks have really crappy legacy technology and, hard to integrate. And I'm not going to discount that. But the fact is that in so many ways, that is by design, meaning these are institutions that are built on trust, that are built and regulated at the federal level, at the state level. They can't mess up. And, whereas, in a consumer-based fintech or in other types of industries, maybe having 99.9% uptime is okay. No, you need triple nines in financial services. Or you're going to worry about are the regulators going to come in and thump you on the head because of whatever type of product decision you made that might have seemed innocuous to a fintech founder, but is really important to the compliance groups at financial institutions. So and we spend a decent amount of time with our portfolio companies helping to translate, okay, what does it mean to sell into this regulated space? Because the rules, requirements, and expectations that banks have of their vendor partners sometimes is dictated by bank policy, but oftentimes is driven by the supervisory expectations as they engage with vendors and make sure that they understand third-party risk and fourth-party risk.
So I imagine fintechs in terms of the people that they're hiring are probably looking much more at people that have got that compliance and regulatory background, because it's just essential for them to be able to demonstrate that they get it when they're talking to the banks.
I think that's right. And oftentimes you think about engaging with banks, you got to talk the language. And, if in that first or second meeting with a potential bank partner, you aren't highlighting the fact that you're SOC 2 Type 2 compliant, or you've got GDPR compliance already built into the system, whatever it might be, to some extent that sends some yellow flags to a bank partner, because whether compliance is in that meeting or not, they're going to need to get compliance involved, risk involved during the vendor onboarding process. So better to have those conversations proactively than to wait for compliance and risk to get invited to the party.
So switching directions a little bit, what are some things that aren't being thought about that probably should be by treasury professionals, by people in the banking industry, the fintech side? What's kind of far from their minds that they should actually be laser focused on?
I don't know if it's far from their minds, but the data component to it, I think, is so critical. The example you gave a couple minutes ago, Seth, about different systems having different data and do they reconcile, do they not reconcile? I think about projects I did during my consulting days 10, 15 years ago that were data management focused. If we're going to take advantage of the promise that AI has, we need really good, strong, clean data. And one of the good things is it doesn't need to be as perfect maybe as it would have been if we just had machine learning models in the past or deterministic models, since LLMs can do a much better job of navigating somewhat ambiguous data. But that said, access to the data and ideally clean, structured data is going to be the engine that drives so much of the promise of AI. And there's that component to it. And of course, banks, good or bad, can be very siloed organizations. So think of a commercial banking customer that there's the company itself, there's the principal of that company who might have a retail account at that institution. He or she may also have wealth management accounts at that institution. It's really hard to figure out how that whole picture knits together and ties together. So it's not just the quality of the data, but it's breaking down of silos that, again, I think the opportunity that AI brings to so many of these institutions is being able to look across and really see that 360 view of a customer in ways that the technology in the past just wasn't able to support. And we're just starting to get some glimpses into what that possibility looks like.
Yeah, I think one of the things, and I've witnessed this going back to I'll call it my operator days. The banks go through mergers and divestitures. The customers, the commercial customers, go through that. And certainly from my days at GE, we were constantly selling things off, constantly buying new pieces. Getting all of that information into our systems to reflect reality was hard enough for us. probably even harder for the banks to keep up with. It seems to me that the AI tools themselves almost need to be up there monitoring all of this stuff in a real-time basis to identify things that need to be changed in the data. To me, it's one of the use cases. It's not really talked about. I talk about it because I think I've always been very data centric, because I've had to do a lot of the data cleanups over the years.
Correct.
But
Yeah.
data cleanup isn't a project. It's a continuity. And I think there may finally be an opportunity to have that as something that's always kind of out there in the background, that's operating, fixing, cleaning, not waiting for an event to happen to then say, oh, well, we have to do a new data cleanup.
I agree. And you think about so many financial institutions are still built on mainframe platforms. So how do you get access to that data and feed that into LLMs or other systems? And we invested in a company called Genies last year that's actually able to do that. So from, really able to unlock data from the mainframe in ways that was never before possible.
So one last question for you, Eric, and this may sound a little self-centered on this, but let's just say that the Treasury Whisperer wanted to start a VC fund.
Don't.
That becomes really simple. So I was going to say, what guidance would you give me if I wanted to go down that path?
I mean, listen,
or for anybody that wants to go down that path.
Yeah, I mean, the hardest part is fundraising. It's like, how do you get people, especially if you're a first time manager, how do you get people to trust you with their money? And I think a lot of it comes down to, at least the Canapi differentiator was the operating experience that our founding partners had and have. And obviously the promise of building a bank network where we're able to support the financial services industry. All that being said, in so many ways, Treasury Whisperer has that like a similar type of opportunity where you've got really deep insight into a pretty niche area, even like a subset of the area that you and I deal with, in terms of like very, very deep treasury experience and expertise. And followership from your listeners. So like, I think about there are so many parallels between the Canapi story and what your fund could be, a very purpose-driven fund, sector-focused fund that gives you, to some extent, an unfair advantage relative to others that might be investing in similar assets.
Interesting. A lot of food for thought there.
But it's really hard.
Yeah, I'm sure it is. And I'm sure there's a reason why I haven't gone down that path already to learn from it specifically. Eric Schwartz, thank you so much for joining me here today in the Whisperer studio.
Great to spend time with you, Seth. Thanks so much.
Absolutely. That is a wrap for us Whisperees. Do you want to appear as a guest on the Treasury Whisperers Talkcast podcast? Consider a sponsored episode. And for more information on that, contact us at info@treasurywhisperer.com. Until next time on the Treasury Whisperers Talkcast podcast, this is Seth Marlowe saying bye-bye for now.
Thanks for listening to this episode of the Treasury Whisperers Talkcast podcast with Seth Marlowe. The Treasury Whisperers Talkcast podcast is produced by the Treasury Whisperer Studio and Treasury Whisperer LLC. Copyright 2025. Any rebroadcast, retransmission, or account of this podcast without the express written consent of Treasury Whisperer LLC is strictly prohibited.